All right. So speaking about gold, right? Gold was completely MIA at the Federal Open Market Committee meeting. Now, considering the fact that gold is the main monetary asset, central banks now have more gold than U.S. Treasuries, foreign central banks. You would think that the rise in the price of gold would at least have deserved a question. I think it should have been front and center. I mean, the Fed should have to address that elephant in the room. But no, the topic was never even discussed. And I've mentioned on my podcast that Alan Greenspan, who people call him the maestro, and he's still held in high regard, including by a lot of members of the Trump administration who speak about him. He specifically said that gold was his barometer of whether or not he got interest rates correct.
Something extraordinary just happened, and hardly anyone noticed. At the latest Federal Reserve meeting, not one journalist mentioned gold. Not one, even though central banks worldwide now hold more gold than U.S. Treasuries and are buying it at the fastest pace in half a century. Peter Schiff says this silence isn't accidental. It's a warning. Gold, the oldest and most accurate barometer of monetary sanity, is flashing red. Schiff reminds us that in the 1980s, Alan Greenspan judged his policies by gold's price. $400 meant money was too loose. $300 meant too tight. So here's the question. If $400 gold signaled too much money printing back then, what does $4,000 gold tell us now? This isn't hype. This is a wake-up call. Because while the Fed ignores gold, the rest of the world is quietly repricing everything. The dollar, debt, and even trust itself. Let's unpack Peter Schiff's urgent message to gold and silver investors, and why he believes the real move hasn't even begun yet.
That even though we weren't on an official gold standard, unofficially we were, because Alan Greenspan still looked towards the price of gold as a market indicator of whether or not rates were too high or too low. And so what he told Congress was $400 gold meant he was too loose, and $300 gold meant he was too tight. And so he was kind of eyeing for around 350. And so if the price of gold stayed around 350, that would indicate to him that he had got interest rates about correct. Well, if $400 gold meant that Greenspan was too loose, what does $4,000 gold mean now? What is that saying about the Powell policy? Clearly, if 400 was represented too loose money back in the 80s, well, then 4,000 certainly must represent the same thing now. And so that's why it should have been brought up. And by the way, my last podcast, I titled it Gold Test $4,000 Support. And some people might think, well, obviously it failed the test because now we're below 4,000, which is the case. We did end up falling below it this week. And in fact, gold closed below 400 today, although it did trade above 4,030 this morning. But it closed below it. As I'm speaking, we're up about $20, but we're still just below 39.50. But also on my last podcast, when I talked about 4,000 support, I did say that it was very likely that gold would go below 4,000 and that 4,000 could be support even if the market was to go below, because I think it's going to be similar to the way we handled the 3,000 support. It wasn't like 3,000 was some line that we couldn't cross. And the same thing with 4,000. We get below it. But whenever you get below it, you are in a support zone. And just like the market never fell too far below 3,000, I don't expect it to fall too far below 4,000, nor do I expect it to stay below 4,000 for any long period of time. because that would give too many people the opportunity to buy it below 4,000. And I don't think that's going to be the case. So I still think that we're at 4,000 support, even if we're trading at 3,950. I mean, we're close enough to 4,000 to say this is where the support is. Obviously, the resistance now is closer to 4,500 because we did get up to, I think, 4,400, because we got up to like 4,380. So we didn't quite trade 4,400, and then we had the pullback. But even with the pullback, where the price of gold is today is considerably higher than it was the last time the Fed cut rates. And the fact that the Fed is cutting rates and the gold price is going up is not a coincidence. Gold is reacting to a Fed that should not be cutting rates. Rates are too low, and the Fed is making them lower. And so the rate cuts are a mistake, and gold is clearly signaling that it's a mistake. Yet none of these journalists who are invited to ask, Powell questions understand enough about money or economics to ask the question or to point out that gold is flashing a warning, or they don't understand the warnings themselves, right? Because, they have to flunk a test on economics before they could be a journalist, an economics reporter at a lot of these newspapers or television networks. And then, then they get to ask these questions to Jerome Powell. Gold is nowhere near that. I noticed I was watching CNBC. They had Jeff Gundlach interview, and he's been bullish on gold, and I'll give him credit for being bullish on gold. And now he's not as bullish because he was 25% gold before, and now he's saying 10% because he thinks it's too high. Well, I think it's already pulled back. But 10% is fine allocation because he said another 5% in base metals, and then he still recommends foreign stocks, emerging markets. So overall, it's still a good idea, but he shouldn't be less bullish on gold just because more people have decided to join in, because it's still the tip of the iceberg. It's still very early. And even though more people are bullish on gold, hardly anybody owns it. Now, yeah, people own gold in their jewelry. People own gold in their cell phone or stuff like that, but they don't own it as an investment. I would say more Americans bought Bitcoin as an investment over the last year by far than who bought gold. So Bitcoin's the crowded trade, not gold. If you own gold, you're still alone, right? It's pretty lonely out there. I know there's a few more people who are stepping up, but the crowded trade and the consensus trade is in Bitcoin, and that's going to blow up. Anyway, let me just get back to the FOMC meeting, because while there were no questions about gold, there was a lot of discussion about the stock market and AI and tech stocks. And some of the reporters were asking Powell, are you concerned about the valuations in tech stocks? And do you think it's related to your monetary policy, right? I mean, and he basically said no. He said he doesn't think that interest rates are affecting AI stock prices, which I think is ridiculous. I mean, obviously, cheap money is fueling the mania, and without it, you wouldn't have the fuel. I mean, he said they don't really care about 25 basis points, which may be true, but in the scheme of things, rates should be a lot higher. And the fact that they're a lot lower than they should be is a big factor. In fact, one of the reasons that you can afford to make all these capital investments is because the cost of capital is low. If the cost was much higher, then they wouldn't be doing it. And ironically, a lot of these investments are being made to replace labor. So the Fed is making it cheaper to automate and to eliminate workers in favor of machines. Maybe if interest rates reflected a true market level, that we wouldn't be doing as much of this yet. Maybe we'd rely more on humans. In fact, two companies this week, UPS and Amazon, announced major layoffs. I mean, tens of thousands of people being laid off. And I think it's mainly because they don't need them anymore, right? Because they are using AI a lot more. But Powell didn't seem to care. He was asked if he thought that the stock market was too high or if he was worried about overvaluation. And he said, well, we really don't pay much attention or care about any individual price, which, of course, he wasn't asked about an individual stock price. He was asked about the entire market, right? The market, the stock market being overvalued is a big deal. It's not like one isolated price. It's this huge market, right, that has major implications for the economy if the market were to tank, right? But to say that, well, it's just one price, so who cares? He goes, we pay more attention to the totality of the market and of the economy, rather, and the credit system, without recognizing how intertwined the stock market is, especially considering that today Nvidia not only hit a new all-time record high, Nvidia now has a market cap of over $5 trillion. $5 trillion. To put that into perspective, there are only 3 countries in the world that have a total stock market capitalization. That means all the publicly traded stocks in the entire country. There's only 3 countries where the whole stock market is worth $5.
Schiff opens by blasting the Fed for completely ignoring gold at the FOMC meeting, even as foreign central banks are offloading treasuries and stockpiling bullion. According to the World Gold Council, 2025 is on track to set another record for official gold purchases, with countries from China to India expanding reserves to protect against dollar risk. Schiff calls this a clear vote of no confidence in U.S. policy. He recalls how Greenspan watched gold to see if rates were right, yet today's Fed won't even mention it. He argues that if $400 once meant too loose, then $4,000 today means total monetary breakdown. When gold briefly dipped below that level, Schiff didn't flinch. He said the metal was simply testing support, just as it did at $3,000 before rebounding. In his view, every pullback below $4,000 is a short-lived gift, a chance for disciplined investors to accumulate before the next breakout toward $4,500 and beyond. He also contrasts gold's quiet strength with the dangerous bubble in tech stocks. Powell insists interest rates aren't driving valuations, but Schiff calls that ridiculous. Ultra-cheap money, he says, is the fuel, and when it burns out, it will expose the fragility underneath. He points to Nvidia's $5 trillion market cap, warning that it's larger than the entire Japanese stock market and a glaring sign of speculative excess. Meanwhile, layoffs at Amazon and UPS reveal another consequence: cheap capital encouraging automation and job cuts while the Fed brags about full employment. Schiff argues that policy distortion has hollowed out America's industrial base. Only about 7.5% of U.S. workers still make tangible goods, compared with Japan and Germany, where manufacturing still drives the economy. Tariffs can't fix that, he says. They'll just raise costs for everyone else. For Schiff, these are all symptoms of the same disease: decades of easy money, asset bubbles, and debt-driven consumption. The cure? Real assets. Gold and silver aren't just hedges. They're lifeboats in a system that's slowly taking on water.
Trillion. The United States and China. And the third one is Japan. But Japan is only worth $5.4 trillion. Nvidia could be worth more than Japan by next week, right? This is an amazing statistic, but it's also a very scary statistic. I mean, the whole U.S. stock market capitalization, I think Nvidia is about 10% of the whole U.S. stock market is one stock. And of course, a lot of other stocks in the AI space, right? In the Mag 7, right? You have such a huge percent of the entire capitalization of the U.S. stock market just in a handful of stocks. This should be very concerning for Powell, but he's dismissing it. He said, hey, it's not like the 1990 dot-com bubble, because he said at least today, companies, they actually have a business plan. Yeah, I mean, they had business plans. They didn't have earnings, but just having earnings doesn't mean that it's not a bubble if you're trading at ridiculous multiples to those earnings, or if your earnings are being driven by vendor financing, where the companies are loaning money to their customers so their customers can keep buying their products and they get rewarded with a rising stock price, right? There's so much stuff. Powell has got his head in the sand to deny that there's a stock market bubble. Yeah, AI is real. So is the internet, right? That doesn't mean you can't have a bubble, right? If it walks like a bubble, if it walks like a duck and quacks like a duck, it's a duck, right? Only the Federal Reserve could look at a duck and not think it's a duck, right? But that's what's going on. But they didn't want to discuss gold, but they at least discussed the tech stocks. By the way, Donald Trump talks about how these tariffs are great for American workers, right? We need these tariffs to protect American workers, right? Well, all workers are also consumers, right? So the workers that Trump wants to protect are also consumers. So they are also harmed by rising prices. But if you just forget about that, if you assume that maybe the tariffs will help them get a bigger raise, so that will more than offset higher costs. In America, we have about 12 million people that work in manufacturing. 12 million. That's out of a total population of workers of over 163 million. So about 7.5% of the U.S. workforce is in manufacturing. So at most, that's who's going to benefit from the protectionist tariffs. In theory. Of course, in reality, they won't all benefit. A lot of them won't. A lot of them will lose their jobs because they're going to work at companies that will be less efficient as a result of these tariffs. But even if you assume that all 7.3 million got a raise because of tariffs, right? Because their employers were able to raise their prices because they had less foreign competition. And because they were able to raise their prices, they were able to pay their workers higher wages, right? So you have a small number of workers who benefit, but only because their employers can raise their prices on a huge number of workers, right? 92.5% of the workers who aren't getting a raise, but are getting higher prices on all the stuff that they're going to buy. And in fact, you can see that if you look at the biggest employers, because I was, looking at, Amazon laying people off. They're the second biggest employer in the country. Amazon, number one is Walmart. But if you look at the top 10 employers in America, 8 out of 10 are retailers. They're stores. 8 out of 10. Those are our biggest employers, retailers. And the other two companies in the top 10 are FedEx and UPS, right? And UPS, again, laying off a bunch of workers. So you've got retailers, and then you've got the companies that deliver the stuff that the retailers sell. But the problem is, where is all the stuff that the retailers sell? Where's it all made? That is the problem. It ain't made here. We are a gigantic distribution center for foreign produced goods. If you look at the top 10 employers in Japan, where the president is, 8 out of 10 are manufacturers. That's where the stuff is being made. It's not just pictures that are coming out of Japan, right? They're manufacturing all sorts of stuff. Country like Germany, 6 of the top 10 employers in Germany are manufacturing companies. We don't have a single one in the top 10. See, that's why the tariffs aren't going to work. We don't even have the industries to protect. Right? They're just going to make what's left of our industries less competitive. But this shows you, right? And the Fed, Powell is talking about how great everything is. We're in such a great place because the Fed has done such a great job of micromanaging the economy with interest rates and making sure that we have full employment and stable prices. This is all a bunch of BS. On the Fed's watch, our entire industrial economy has disintegrated, and we've outsourced all of these manufacturing jobs, and we've replaced them with these service sector jobs. And we have this gigantic credit bubble. And Powell is completely clueless about any of this, right?
So, what's Peter Schiff's message to gold and silver investors right now? Hold your ground, stay patient. The noise in paper markets means nothing next to the signal of global accumulation. Central banks are buying, the Fed is still printing, and investors waiting for confirmation will miss the turn. If $400 gold once meant easy money, then $4,000 gold means we've crossed the point of no return, where trust in fiat currency starts to crumble. Schiff believes we're right there, on the edge of a global reset. Do you agree with him? Is gold screaming a warning that the Fed refuses to hear? And if so, how high could gold and silver soar once confidence in the dollar finally breaks? Share your thoughts below. I'd love to hear your take. If you found this breakdown valuable, make sure to like, subscribe, and turn on notifications, because the next few months could change everything for gold, silver, and the global economy. This is Macro Edge, keeping you ahead of the curve every step of the way.